All right, so risk management, trading psychology. I get it. This week is definitely a little bit harder. We've had some choppy price action. Last week provided a lot of opportunities, mostly to the short side. I think Monday we also were green, I think, but again, I get it. It was very, very choppy price action overall. Okay, when it's choppy and when you don't have a defined edge as a trader, you need to know when to sit out and be all cash. Okay, now personally, when it's a choppy market condition and it's not in my strength, what I like to do is I really draw back my position size. Okay. My position sizing, I run multiple contracts. When I shrink my position sizing because I know the market is either chopping it up or it's not in my strength right now, my strength as an individual trader, I really shrink my position size. Okay. So what I mean is, okay, for example, Microsoft bull flagging on the 5 minute time frame, but the triple Qs and SPY have been chopping it up all day. They have a set top and they have a set bottom. Okay. Without SPY and triple Qs trending up, that Microsoft bull flag breakout is going to be low probability. Okay. It doesn't have the indexes moving with it. Overall market sentiment isn't matching. So therefore, a breakout of Microsoft either is going to be very limited in its breakout, or it might just be a fake out. It wicks up for one candle, closes above, and then it completely fades the entire move in the next candle. Okay, this is when added risk comes into play when it's choppy market conditions. All right. Now, earlier I said SPY puts below or 450, excuse me, for example. Okay. If you didn't pick up on this triple top, which is perfectly fine, I didn't up until I started this Zoom meeting. Look at what SPY has now done. Okay. I mean, this is really difficult to trade it. I'm not going to sugarcoat this. Here's the entry for the shorts. And why is that an entry for short position? Well, look where the buyers are. Okay. Buyers are here at 450 and they push price up $3. All right. So now look what happens when price breaks 350. It drops 50 cents and catches a bottom. Okay. That's the really, really tough trading conditions that we're dealing with right now. Okay. You get a break of a key level, but it doesn't give you a big break. Okay. You're going to see nice profits right away because it's breaking support. IV is going to start to come into the contracts. But notice this bounce that's happening right here on this 5 minute candle and that push up. That's going to kill profits right away. That IV is going to come right back down to where it was before. Notice though, it did reject at 450. So the possible short thesis is still in play so far. This 5 minute candle doesn't close for another few more minutes. Okay. Either way, this is really choppy market conditions. Nobody can really trade and chop. Okay. Unless you're a scalper with a big account and you go in with 10 to 20, 50 contracts, you're in and you're out with limit orders, then you can make good money. But at least talking about my edge as a trader, and I like to go in heavy when it's my strength in a trade, this is not optimal market conditions to trade in. Okay. Shrink position sizing during these market conditions. Last week, 2 weeks ago, 3 weeks ago, hell of volatility all over the market. Okay, we made really good money during that stretch. That is your time to let runners run, but to also keep in mind position sizing. Volatility can kill options right off the bat. I mean, IV alone soared a ton of options. I was looking at Snapchat earlier this week. Snapchat was on my weekly watch list. I looked at calls the swing for Snapchat because it started to hit my levels for everyone. IV was at 230%. There is no way I'm going to enter an option trade, let alone put other people in it with IV that high. I mean, that's insanely high IV. Snapchat's IV, I think, historically runs around 50 to 60%. And 60% is probably on a big day for Snapchat. 236% IV, that's insane. Okay. These are hard market conditions to trade in. When you see an opportunity to trade, size down. Okay. If the trade moves against you, you will take a minimal loss. I went in with one contract on Qualcomm earlier or QCOM. Okay. One contract. That was it. I didn't even enter it in my main account. Okay. And I'm going to talk about that in a minute. All right. QCOM, I exited before my stop loss hit. Why? Because the market started to reverse. Triple Qs look to be breaking out with QCOM after monster earnings. QCOM starts to break out to the upside. It faded its move with the market, but then started to bottom and come back. There was buying pressure showing up. I think Alex hit on it on the 15 minute. I was watching the 30 minute with buying pressure show up. Okay. The markets and QCOM ended up fading that little breakout that they gave. All right, we exit below my stop loss. Okay. Instead of my stop loss being hit, I exit early because price action was telling me to exit then. Okay. Why should I exit? Or I exited, I think, at 20% profit or 20% loss, excuse me. Okay. If the chart is telling me that the exact opposite is happening from my position and it doesn't look like it's going to stop, why should I hold on to my position hoping that it reverses before my stop loss hits? Okay, that makes no sense. Exit the trade, keep the small loss, and move on to the next. Okay, there's no reason for why we should let a stop loss be hit if price action is confirming that that trade is done. Okay, if it's a loss, so be it. I mean, there's losing trades every single day. We're all going to take losing trades. It's about letting our winners outweigh the losses in the end game. Okay, so that's one thing that I wanted to go over. All right. Another thing, and I tell every single one of my mentorship groups this, and a lot of them told me, I tell them this in the beginning, and my mentorships run for the entire month. And then I circle back to this at the end. And overall, it's been positive feedback for everyone who does it. Journal your trades every single day. Grade yourself as a trader. Okay. I'm going to read off of mine right now. I literally have, like in high school, a grade sheet that I grade myself off of. Okay. I grade myself A, B, C, D, or F every single day as a trader, as far as everything goes. My execution, my discipline, my patience, planning. Did I prepare for the day? Was I up on time? Did I start charting before market open at least a half an hour, which is one of my personal rules? Okay. Did I wait for confirmation of the setup to enter a trade? Did I exit at my profit taking points? Did I leave runners? Did I follow my stop loss rules? Okay. All that good stuff. I grade myself as a trader because as a trader, we have to hold ourselves accountable. I can preach all day long, but I can't sit there next to you and press the buy and sell buttons for you. We have to be our biggest critic. Now, I'm not saying destroy yourselves mentally and think that you'll never exceed, because that's the total opposite of what I'm saying. But give yourself constructive criticism. Write down all your strengths as a trader. Okay. What are you good at? Everybody's good at something in the markets. Okay. Everybody has their strength. Some people, it is scalping at the open, playing the opening drive. Other people, personally like me, it's swing trades, finding trades that can, you can catch a $5, $10, $15 move over the course of a few days potentially. Okay. Other people, it's day trading, catching the highs and lows. Other people, Fibonacci traders. Fibonacci traders can be some of the best traders out there because they stick to their fibs and they know when to take profits, and it keeps them consistent. Okay. Write down all your strengths as a trader. Write down all your weaknesses as a trader. Okay. As you start journaling every day, you will be green and you will be red. I want you guys to see what market conditions do you trade best in. Is it volatility, or is it a low melt up, or is it this choppy price action? This choppy price action, if you're disciplined and you see profit and take profit, you can be green. It's going to be tough though. And what I mean is this right here. You buy SPY calls on this bottom. Okay. This is a triple bottom right here for this 5-minute candle, and it turns into a quadruple bottom. Okay. If you went long right here on SPY calls, your hard stop loss is going to be 450. As a scalper or as a day trader, that is your hard stop loss. SPY goes below 450, you're done. You're out. You follow your stop loss. Okay. But if you're a day trader and you're a scalper, this is the stuff you live for, because you pretty much bought at the bottom and you're able to ride this all the way back up as IV comes back into the options and price starts to move the contracts up for you. Okay. Now, again, flip it on the flip side. You look for these intraday triple tops. All right. Here is SPY triple topping just under 453. It never actually prints 453, but you see there's a supply zone. Okay. You see this 5-minute candle reject under 453. You go short. Where's your stop loss? Right at 453. If price goes a tick above 453, you're done. You're out. You exit the trade because SPY might lift off. Okay. Sometimes that is going to be a risky strategy, because notice what SPY did on this 5-minute candle. It wicked right above 450 again, and then it went back down. Right now, buyers are struggling at 450. But say that was your stop loss. Okay. You're done. You're out. SPY wicked and hit your stop loss. You don't know if it's going to keep going. You don't know if it's just one wick above the fake in people, and then it goes right back down. Okay. You don't know, but those are the rules that you have to follow. So The longer that you journal every single day, you're going to see your strengths and you're going to see your weaknesses. You're going to know what market conditions you trade best in and what market conditions, excuse me, that you trade worst in. Start to pick these things up, and I promise you, they will come to you over time, but it's going to take time. Okay. This is a never ending marathon, in my opinion. There's always going to be a learning curve. Okay. I'm 5 years in and I still learn something new every single day. Some of the greatest traders out there that we all follow on social media and whatnot, they will tell you the same thing. The day you start to think or tell yourself that you have it all figured out, that's when the market's going to give you the big reality check that you need. Okay. And the market will humble you with pleasure. The longer you trade and you journal every single day, and this is going to take time, you will see where you perform best and where you don't. Now you're going to build your edge as a trader. When you know when you trade best, you just get to sit back and wait for the opportunities to come, right? Isn't that what I always say in the market? There's always going to be a new opportunity, okay? Or excuse me, that's what I always say in the server. There's always going to be another opportunity. Tomorrow will be another opportunity, okay? The market is an endless flow of opportunities, to quote Mark Douglas. That's one of the best quotes I think I've ever heard, if not the best, okay? If you don't find when you build your edge, let me phrase it this way. When you build your edge and you don't see a setup that fits your edge, why trade? Why waste money? Why go in on that 50-50 setup when instead tomorrow could bring a 90-10 setup? Okay, now 50-50 setup, I mean 50% probability it works out, 50% probability it doesn't. There's no certainties in the market. So the 90-10 setup comes into play. 90% quote unquote certain. I say that very liberally because there's no certainties in the market. But for Facebook, I was pretty damn sure I knew what was going to happen because of everything that I wrote down for it. Okay. As an example, that 90% to 10% setup, you have 90% probability of it working out in your favor because you know your edge and you did your due diligence. That 10% it doesn't work out, it's just the market. You never know what can happen in the market. Okay. A lot of people got a wake up call yesterday with Facebook earnings. And I got a few DMs with StockTwits, kind of like, how did you know this? Blah, blah, blah. And it's because people are accustomed to different market conditions than what the market's going to give. All right. But circling back, I want everybody to start journaling. Every single day you journal. Okay. Now, it might not mean much in 2 weeks, but it will start to mean something at 3 months. 3 months from now, we will circle back. What is it? March, April, May, beginning of June, end of May. I will circle back with everyone who is on this Zoom meeting, and I'm going to be able to know who paid attention and who didn't. Okay. By the answers that I'm going to get. Start journaling your trades today if you don't already. If you already do journal your trades, that's awesome. Now take it a step further. Grade yourself as a trader, write down your strengths and weaknesses. Okay. You will be able to tell when high probability setups come your way in the market based on your trading style. Okay. Trade to your strengths. Forget about your weaknesses. Why focus on your weaknesses? Why improve? Why try and fix your weaknesses? Okay. My weakness is day trading and scalping. That is my weakness. Now, as the trading day develops and I get more candles, more bigger time frame candles to come in, like hourly candles, I get some 30-minute, 15-minute candles to form right around now. That's my strength in day trading. This opening drive stuff and day trading at the open, far from it. That is not my strength. Okay. Those DIA calls that we traded, those DIA and SPY puts that we traded 2 and 3 weeks ago, all those entries came in the middle of the trading day, and we were able to ride the waves down or up later on in the trading day as the day went into power hour. Okay. That's where my strength is as a day trade. QCOM, a lot of stuff went into QCOM this morning for why I entered calls when I did. Okay. Start journaling now. In 3 months, I promise you, you will know your strengths and weaknesses. And when you know your strengths, trade to them. Okay. If you don't see your strength on the market that day, cool. Wrap it up, close up shop. If you're a day trader in the morning, shut it down for the day. Go enjoy the rest of your day. Come back for power hour because power hour can offer opportunities. If you're a swing trader, unless you have an open position at the opening bell, don't even come to your screens until lunchtime. Start looking for high probability swing setups around lunch. I have done that many times before because during the bull market that we had the last couple of years, that is basically what I did for a majority of it, because that's what my strength was. And it was easy to just go long with calls and to wait for the lunchtime lows to come in and kill option premium. Okay. But again, to say it one more time, because I'm really going to ingrain this in all of you, start journaling today. If you don't already, come back to me in 3 months and I'll circle back with this Zoom meeting. Tell me if it improved your trading or not, because you're going to learn from your mistakes and you are going to learn what market conditions you trade best in. And when you figure that out, you just get to wait for the trades to come to you. Okay. And that's the best thing of all. All right. Let's see. I'm going to talk about position sizing one more time. I know it kicked off the meeting about position sizing. It's a choppy market. It's a volatile market. Okay. Volatility. I would probably say 50% of traders out there don't like trading in volatility. Okay, there's some people that love it. I know of one trader I found on Twitter, he lives for volatility and he will go weeks without trading. And when the volatility comes back and he finds a setup that he loves, he is all in on it. And he's probably got like a 90% win rate from what he says. And I'm taking him at his word for what he says. Okay. There's some people that live for it. Okay. Volatility is not a lot of people's friends. Okay. Choppy markets is not a lot of people's friends. Okay. A swing trader hates choppy markets. Okay. A swing trader trades with the trend up or down. There's nothing to trade as a swing trader. There's no trend. It's just trending sideways. That's not the magic number, or that's not the move that any swing trader wants. Okay. A scalper, a day trader. Yeah. If you're quick and you time your entries right and you stick your stop losses, you can trade with chop. Okay. Volatility and choppy markets, that's the time to bring position sizing down. A lot of people don't feel comfortable trading in those market conditions, and that's perfectly reasonable. Okay. That's perfectly reasonable. Size down. Okay. If you see a 50-50 setup, like what I went over, enter with one contract. Okay. I'm being serious. I have no idea how big your accounts are. Okay. My position sizing, it goes by threes. That's all I'm going to say about my position sizing. My position sizing goes by threes. Okay. In my main account. If you see a 50-50 setup and you think like you did your due diligence, whatever, enter with one contract. Okay. If the trade works out in your favor, that's awesome. You're green. Be happy with the profits that you made. Okay. See profit, take profit. It hits your levels, move on, exit the trade for profit, move on to the next. Okay. If the trade moves against you because it was 50-50, okay, you keep your losses small. You entered one contract. Okay. If it's $100 contract and you exit for a 30% loss, okay, now it's only $70. Or excuse me, you keep $70 of the $100 that you just spent. Okay. It's only a $30 loss. That's not that bad. You go in with 3 contracts though, because say that's your normal position sizing. Every trade you take, you buy 3 contracts. Well, that 30% loss, you spent $300. That sucks because now you're losing $90. Okay, that's a bigger hit on your account, especially if you've got a smaller account. Let's say $1,000. That $90 loss, that's quite a bit of money that you just lost in your account, and you traded it with a 50-50 setup. That's not the setup to go in with normal positioning. Okay, so pay attention to market conditions, pay attention to the stocks that you're trading. Okay, if it's volatility and you don't like volatility, size down or just wait. Wait for volatility to pass over. Okay, there was probably a lot of people who didn't trade 2 or 3 weeks ago because the market was so volatile and they didn't feel comfortable doing it. Hats off to them. They know when to not trade. Okay, but I'm going to say this now, and I think today reaffirms it. Volatility is here to stay for quite some time. We're not going to go back to the 2020 and 2021 bull markets for quite some time, in my opinion. Okay, I really do think volatility is here to stay. But as far as the 1,000-point drops on the Dow Jones, that's probably going to go away for a little bit. But as far as volatility, like yesterday into today, yeah, that's here to stay. But the 1,000-point drops in the Dow Jones probably going to be a little bit longer before we see anything like that. I would think until March, unless there's a big catalyst coming our way that we don't know about yet. All right. Psychology, real quick. gonna hit on psychology, and then I want you all to ask me questions, and I'll be more than happy to answer. Okay. If you ever feel like you're trading bored, okay, you're bored, you're trading when you're bored. That is the worst thing that you can do as a trader. Um, as far as a mindset goes, I think. I mean, there's a lot of things that I think is probably the worst things out there. I'd probably say that a lot, but trading while bored, that is going to be, I think that's something that's not talked about enough when people trade and they're bored. Okay. I'm talking from personal experience here, by the way. I'm going to light myself up over this. I have lost a shit ton of money trading while being bored because I had nothing else to do and I wanted to take a trade. Okay. I wanted to be green on the day. I needed to catch up to people. Okay. That is totally 100% flat out wrong. That is the wrong way to go about trading. Okay. You don't chase anything because when you start looking for trades and you start looking for that trade that can make you green on the day, or looking even worse here, looking for that trade that can take you from red to green on the day, because now you're trying to make up losses on the day. That's even worse because now you're really going to start looking. Okay. That's a really good way to either extend losses for a bigger drawdown if you're already red on the day and you're trying to take losses, or that's a really good way to waste buying power so early on in the day before the whole trading day comes to a close. Okay, as a swing trader, I'm going to talk from personal experience here. I would try and make up swing losses from the previous night or in the morning that I took with day trades. That's not my strength. I've said that quite a bit through the server, but I haven't said it recently. My strength has never been a day trader. A few weeks ago, as the volatility came back, I had to adapt with the markets and I did what I had to do to stay green and make money. Okay. My strength is a swing trader. If I had swings open red, what I found myself doing for about 6 months before I was able to finally correct this was I would start day trading to make up my swing trade losses. Okay. Well, what does that do? That burns premium. That burns my buying power that I could use for swing trades that come, and those setups come later on in the day when the market is nearing close. Okay. The daily candles start to get into how they're going to close. The second 4 hour candle is getting closer to close. The hourly candle, the power hour hourly candle is a really good hourly candle to look at for swing trades. That's a 1 hour that I get to look at it. Okay. But here I am trading in my trading in my weaknesses, trying to make up losses that I didn't accept full risk for, by the way. Because if I'm trying to make up losses and it bothered me that bad, that's a sign that I didn't accept full risk. Okay, that's a huge red flag. All right. So, talking from personal experience here, if you ever see yourself trading while bored, you need to shut everything down and literally get away from your desk. And I mean this in a literal sense. If you trade at your desk like I do, whether it's in your home office, whether it's at your kitchen table, I mean, whatever, if you have a laptop that you trade on, whatever it is, you need to shut everything down and literally leave the room. Okay. That is what I have found that gives me success, is when I leave the room. Now, you also have to have like the self control not to open anything on your phone and try and find a trade that way either. Okay. But I've found back then when I struggled with this issue, shutting my laptop down, closing out Thinkorswim, TradingView, and any brokerage app that I had open was a lot easier. And I was able to eventually, that's what helped me overcome it, I guess is the best way to say it. You still have to have that self control, not opening your phone, not looking for a trade on your phone, and then entering on your phone as well. And another thing, talking from personal experience, my DD is done better when I work on my MacBook. I trade on a MacBook only, and I use my phone for execution to enter trades in. That's how I work. You mean what you're looking at right now is what I look at every single day. And when I enter trades, it's on my phone when I try and get my fill price that I want. What I have found is when I find a TA setup on my phone and I didn't look it over on my MacBook, it tends to work out against me. When I enter trades on my phone and I do my TA and my DD on my phone and I never look at it on my MacBook, it works against me. I think it's probably because I'm accustomed to my MacBook. Like it's all psych as what I think it is, but that's another thing that I picked up on. trading on my phone is not a strength for me. Some people can trade really well on their phone and they can look at those small charts because it is smaller, whether it's Thinkorswim or TradingView, and they can execute perfectly fine. Personally, for me, that's another issue that I know that or not another issue per se, but it's another weakness that I have. So if I don't find a setup by the time that I leave, either to go out to lunch or to start my evening plans, I'm probably not going to trade at all. I'm probably not going to have any swing positions open, and I'm not going to trade on my phone. Okay. So that's one more thing that I wanted to say about patience and being bored as a trader. All right. Does anybody have any questions for me? I asked everyone to come prepared, but it's okay if you did, about any risk management, psychology questions, and all that good stuff. And by the way, for those of you who started this Zoom meeting with me at the beginning, we watched SPY break 450. Look how painful this would be to trade. Okay, you get a 50% or you get a 50-cent drop. Okay, that's going to make you green, but it's not going to give you the profits that you want. That might hit 5 to 8, maybe 10% profit if you short it off of 450. 10 minutes later, it hits your stop. Okay, now it moves past 450. That's your stop. Look at the next 5-minute candle, right back down to a new low of day. What happens to the next 5-minute candle? It erases 80% of that red candle. Okay, this is really, really difficult stuff to trade in. It's honestly borderline not worth trading until power hour, I would say. But does anybody have any questions? I really, really don't want to leave anybody out, and don't want to leave anyone hanging. And ask your questions, even if you think they're stupid. There's really no such thing as a stupid question. There's no questions. That's okay too. I'll go ahead and get started. Talking about Facebook and other stuff. Oh, you know what? While possibly anyone is typing out questions, and it's okay if you have multiple. Anyone that took those Facebook lottos with me, I want you to do exactly what I'm going to do. I'm transferring out every single dollar of profit that I made off of that trade. Okay. It is going to be payday tomorrow, Saturday, or Monday, whenever the hell this ACH transfer goes through. Okay. I'm not going to wire that one, but it is payday. Every single dollar that you made off of that Facebook lotto, I want you to transfer out if you took it with me. I know at least one member said it earlier, possibly a few more. Transfer every single dollar out. Do not trade with it. You're going to pay yourself because, God forbid, say 2 weeks from now, trading the market sucks. It's hard conditions to trade in. You blow your account or you see a serious drawdown in your account. You now have free money to pull from. You don't have to pull from your savings. You don't have to sell any of your investments like crypto, which I unfortunately have done a year ago when I had an account take a serious drawdown. I had to pull money from crypto, eventually bought it back. But, that's a sucky thing. You don't want to sell stocks, okay, that you're holding long term. Okay, you don't want to pull from your checking account. You don't want to stress yourself out over finances. This Facebook lotto is now free money. $91 turned into 2,600 and some odd change. Okay. What an incredible risk to reward ratio that is. Transfer every single dollar out, and that's free money. Put it towards a bill, treat yourself this weekend, or put it into a savings account. And, God forbid you blow your account. That's free money that you now pull from, and it doesn't affect your personal finances one bit. Okay. That is also one thing that I wanted to say real quick. And I'm going to make an announcement later to the team as well about that, because I know not everyone's on. Talking about blown accounts. All right, so blown accounts. At least 2 members say they blew their accounts this week. I really hope they're doing better today. I know one of them is because he posted profit earlier. Okay. If you ever feel like you're getting closer and closer to a blown account, I want you to take like 5 days off. Take a full trading week off of trading. All right. Now, if it comes into, say it happens on a Wednesday, serious drawdown, or you actually blow your account up, if you actually legitimately blow your account up, at the minimum, I want you to take 2 weeks off. Okay, 2 weeks off of trading. Do not trade for 2 weeks. The market's going to be there 2 weeks from now. You're not going to miss anything. Okay. I missed, to lead off of that, one of the members asked about earnings and feeling like he's missing out on something. Okay. At best, it was an educated guess for me that it worked out this way. Nobody looking at Google, nobody knows that they're going to announce a stock split. That's what really sent that stock roaring high, was the stock split announcement. Okay. TDD or TTD, Apple, Nvidia, Tesla, they've all done it. They've all announced stock splits, and that's the reaction. Okay. That's what's going to happen every single time that a stock split announcement is announced. It just roars to the high heavens because that's what people like to FOMO into. Okay. Ignore it. Ignore it all. Okay. Ignore the earnings bias and whatnot. And unfortunately, I just lost my train of thought a little bit. So I'm going to try and circle back in my head real quick because I started talking about too many things at once. Oh, blown account. Okay. Talking about a blown account. Take 2 weeks off at a minimum if you actually legitimately blow your account. Okay. If that happens to you. Now, if you see a serious drawdown in your account, let's say you hit a 30% drawdown, or, at worst, 50% drawdown overnight. So you took say you took Facebook calls overnight. Okay. And that gives you the serious drawdown. Okay. You loaded the boat with Facebook calls, and now you're 50% down on your account today. Take at a minimum 5 days off. Give yourself that mental break. Okay. The market's not going anywhere in those 5 days. Okay. You're not going to miss anything. Okay. People missed that Google earnings lotto. All right. Well, guess what? They might have missed the Facebook earnings lotto too. Those are not the trades to take. Those are not high probability trades to take. The high probability trades to take happen from the opening bell to the closing bell. Those are the high probability trades to take. Okay. Earnings lottos, those are all gambles. Okay. You don't want to be like some shit poster on StockTwits, blowing your account and then praying that something goes your way to bring the stock back up after it drops 20% in after hours trading. Okay. If you ever hit that serious drawdown, if you ever blow your account, take the time off, give yourself that mental reset, maybe even delete the trading apps. Okay. Delete StockTwits, delete Twitter, delete your brokerage apps. Just don't forget your logins. Okay. Take them off your phone so you're not even tempted to look at anything or make yourself feel bad. Okay. The market isn't going anywhere. Give yourself the mental reset. Okay. Again, I'm going to talk from personal experience. I've been through 6 blown accounts. In my opinion, and I will stand by this, anybody who claims to be a successful trader and a profitable trader, if they tell you they've never blown an account, that is the biggest red flag that they can say. And in my opinion, it's automatic bullshit. They're a liar. Because in my honest opinion, it is tuition. Everybody pays tuition to the markets. That blowing your account is one way that you pay tuition. Okay. It is a steep learning curve. Some people find success in the very first 6 months. Other people, it suddenly clicks in 8 to 9 months up to a year. I've known some traders, it clicks for them at 6 years. 6 years of trading, trial and error, profit and loss, either break even or red overall. And then finally, at that 6-year mark, they hit it and it all clicked in their head and they never looked back. And they're now a very successful trader. Okay. Everybody's on their own journey. But if anybody ever tells you that they've never blown an account, to me, that's bullshit. I mean, everybody pays their tuition to the markets. I paid it 6 times. Through 6 blown accounts, I probably lost $10,000 to $12,000 between those 6 accounts that I blew up. Okay. If you ever blow your account, don't feel bad. We've all been there and done it. Okay. I'm the first one to tell you. Okay. I've been through 6 of them. Okay. And some people get shocked when I say 6 accounts. Go on social media. I'm sure you can find people who have blown 10 to 20 plus accounts. Okay. Really, I'm being serious. Don't feel bad if you've blown your account recently, like today, this week, or in the past. It's really not something to be ashamed of. We have all been there before and we understand how you feel. All right. Now I'm going to ask one more time before I switch gears. Does anybody have any questions for me about risk management, psychology, any of that good stuff? Because I really, really don't want to leave anyone hanging. All right. If there's no more questions, then I'm going to switch gears. All right. So I hope everyone read. Oops, that's not the link. I hope everyone read my notes on Facebook because this is where they came from. This is quarter 3 conference call. Okay. And let's go back in time here real quick. And we're going to look at Facebook or the whatever their stupid name is, Meta platforms. All right. Let me lock this chart back in because this is honestly nothing new. All right, here is Facebook's last earnings call. Okay. This is what happened on Facebook's last earnings. They reported after hours on October 21st. Okay. Here they are opening on October 22nd. Look at the drawdown that they did. Okay. It was a monster gap down. And I'm going to tell you why they gapped down. I'm going to show you why. But this was the impact of their gap down. Okay, this is because of everything that they said in quarter 3 that nobody listened to. All right. And Amazon is really starting to tee itself up. I'm sketch. I'm 50-50 on Amazon. Facebook, I was 80-20. I was 80% sure Facebook would see a gap down. I just didn't know how big. I didn't know that I would be like $30 in the money like I was or like I am right now. Okay, that I didn't know. But Amazon, I'm honestly 50-50, and I'll talk about Amazon later. But for Facebook, here's one thing that sticks out to me. Okay, quarter 3 total revenue was $29 billion. Total revenue for Facebook, $29 billion. Okay, quarter 3 ad revenue, $28.3 billion. All right. I'm not good with numbers and math was never my strong suit, but I'm going to go out on a limb. I'm going to say their ad revenue accounts for about 98% of their total revenue that they made in quarter 3. Okay. Notice these words right here, ad revenue, and then look at the exact numbers, 29 billion, 28.3 billion. Okay. Ad revenue. I really can't stress that enough. This right here says it all. That is that's their only revenue source, in my opinion. Like that's $0.7 billion. That's not even a full billion. It makes up the rest of the revenue. That's nothing for a giant like Facebook. Okay. Here it is, literally other revenue, 734 million. Okay. This is literally nothing compared to $28.3 billion. That is like Neptune and Venus. Okay. That's how astronomically far apart those numbers are in terms of revenue for Facebook. Okay. Now I'm going to scroll on down. And there was one more thing I want to go over. He talks about, I believe, his name's David or Dave, and I forget his exact job at Facebook, but he starts talking about the numbers. Sheryl Sandberg is the COO, and then of course Mark Zuckerberg is the CEO. But Dave, right here, when he's talking, I can't find it. I think it might be down here with Outlook. He starts talking about how expenses go up. Okay, so now revenue, we saw the revenue numbers, but now we're also talking about expenses going up. Here it is, right here. Turning now to the expense outlook. Okay. Expenses to be 70 to 71 billion, updated from our prior outlook of 70 to 73 billion dollars. Okay. This is their total revenue or expenses, from year to date at quarter 3. I think if I'm reading that correctly and I interpret that correctly, that's what it was. Okay. Notice the numbers, 70 to 73 billion dollars. 2022 total expenses will range up to 91 to 97 billion dollars. That is a $20+ billion increase in expenses for Facebook. That is a very, very big jump. Okay, that stuck out to me as well. Huge jump in expenses that they were pricing in for 2022. Okay, that's something that I also noticed. All right, now what earnings season is this? This is quarter 4. All right, now we're going to keep on coming down here, and I love this guy, Dave. Whatever his last name is, Dave. He nails this question right on its head. Okay, on the monetization front, we're just starting to roll out ads on Instagram. So it's earlier on that front, and we haven't really gotten to a monetization point with Reels on Facebook. Cheryl, do you, and here it is, do you want to take on the iOS 14 question? Okay, this is the gut punch that I needed to see. Okay, there are two big challenges coming from the iOS. All right, and it really is a double-edged sword. And one thing that I want to say, I don't know if everyone knows this, but it's kind of funny coming from my point of view as a consumer. These ad companies always get, or these ad companies, these tech giants always get blown up on DC and in the media for being biased, right? Both sides of the political aisle say tech or big tech and all these tech companies favor the other side. It's always a poking game. DC hates them, they hate DC. Well, above all that, these tech companies despise each other to their core, and they want to see the demise of them. What Apple did with this iOS change is a huge gut punch to Facebook. And this really does now put them into fundamental peril because this is monumental stuff. I showed you the revenue numbers, and I'm going to flip to that in a minute here. But this is like some serious, serious stuff that Apple did to Facebook that really, really does put their future in jeopardy. And that's why I can't stand everyone screaming to buy. Okay. The first thing that happens in another Discord after Facebook reports earnings tomorrow, or reported earnings yesterday. Okay. He didn't even read the numbers. He didn't read why Facebook had such a disastrous gap down. The first thing he says, buying Facebook leaps at open tomorrow. Are you kidding? You don't even know why Facebook reacted the way it did. And at that point, after hours, we're talking from 323 at a closing price down to 270. Okay. That is a 50+ point drop that Facebook does in about a second. And you're already talking about buying leaps and you don't even know why. This is what I mean. Half of retail is not going to be around next year because that's the very first thing that they go to. Buy the dip. Okay. Buying the dip doesn't always work. Ask about Blockbuster. Ask somebody who was trading from 98 all the way up to 2002. Ask them about Blockbuster, how Blockbuster fared through the dot-com bubble. Where is Blockbuster now on the stock market? Okay. And Netflix, I'm telling everybody right now, Netflix is my next one that I'm coming to because I'm taking aim at Netflix because that CEO should have never said what he said. But I'll talk about that later. All these tech giants hate each other. And what Apple did was a giant FU gut punch to Facebook. And it really hit Facebook at its core because Facebook's whole business and revenue comes from ads. They make money through ads because they would know their users so well and exactly what their interests were. And they were able to target them specifically with ads. And businesses love that because Facebook would get it literally to the exact person that the company wanted, and it would help with sales for other companies. Okay. Apple taking the privacy issue, acting all grand about it and saying that we're protecting consumers. Well, I don't really buy that. I think it's just more of an FU to Facebook because they don't like each other. But anyways, that's the stand that Apple takes. So Apple takes this to protect their consumers. Okay. This is now a fundamental issue for Facebook because their ads can't be as accurate as they once were. Okay, their ads that they were really known for and that businesses love them for because they were so accurate and Facebook could get it to the exact target audience that every single company wanted. Guess what? It's no longer as effective. And I'm talking from a personal standpoint. I myself have noticed a difference in Facebook ads from before that this thing happened to now. I really do. And I run ads on a very, very small scale, probably twice a month. I notice a difference from last year to now. And I can't imagine what a company we're talking about like $1 billion plus company running advertisements on Facebook feels. Okay. So what happens when all of a sudden you're not getting the results that you wanted to on Facebook as a company? What do? You take your money elsewhere. Okay. You're not going to pay Facebook for advertisements if they're not working as good as they used to. Guess where all that ad money went? Right to Google. Google is now soaking it up. And I hear rumors that Apple and Amazon are also trying to get in onto this ad war as well. If Apple and Amazon start making serious headway in this, Facebook is really, really up shit's creek because a lot of people use Amazon. I don't know how Apple can really work with ads unless it's something on Apple TV. But even then, that's not that popular. That's not a main driving point of their business. But if Google starts taking Facebook's ad audience or Facebook's ad customers. That is another serious death blow that can come to Facebook. Okay. And this is all now going to start to come for full circle. This iOS change hits them on two fronts. Okay. Under reporting, blah, blah, blah. Okay. They're basically saying that how bad it is. All right. So targeting, this is one of their two challenges. Real quick, let me circle back. Two big challenges right here. Okay. The one is targeting, and then the one is measurement. She talks about measurement. This is Sheryl Sandberg, by the way, talking now, COO. She's talking about conversions right here. She thinks that they can fix that issue for conversions by the end of this year and then more into this year. Okay, so let me backtrack because I realized what I just said. When she says done this year, keep in mind that's 2021. This is Q3 2021 earnings report. Came out in October of 2021. So when she says more in the next year, she's talking about 2022. What does this mean? This issue right here on conversions alone, they're not fixing right away. That's a hard fix. It's at least into this year of 2022. That's bad news. Now, here's the kicker. Targeting is a longer term challenge. Okay? Longer term. If we're already talking about an issue that's into 2022, and we see this at the end of October in 2021, we're already talking about a month's time frame right now. Okay? In months, for a company like Facebook, we're talking hundreds of millions, if not billions of dollars that is possibly that they're missing. Okay? But now targeting is a longer term challenge. So if we're already talking longer than into 2022, how long are we talking? So we have to rebuild our targeting and optimization systems to work with less data. That's what made their ads so effective, because they worked with all of their users' data and they were able to directly pinpoint companies' ads to their best suited customer. I mean, it was crazy good what they were able to do. But of course, Apple takes the mighty high road of we're protecting our consumers' privacy. Okay, if that's what they want to tell the public. In reality, don't forget, they all hate each other. Okay, this is a multi-year effort. Those 6 words is what I needed to read to know that I was probably going to lotto puts for this Facebook's earnings that we did. Multi-year effort. That is really, really bad. Like, this is an issue that's going to last years for Facebook to fix. Okay. Now, here's me thinking out loud. Okay. And this is what I personally think. I think Facebook and Zuckerberg and Sheryl Sandberg really do realize how far up Schitt's Creek they are with this iOS change. Like, this is brutally, fundamentally bad for Facebook. And I think they realize how bad it is, because we're talking about years to change, and it will never get back to what it was because Apple made the changes that they did. Okay, so they're not going to be able to get back to that. Okay, what did I say a few minutes ago? Facebook makes its revenue like $28.3 billion out of its $29 billion total revenue comes from ads. And it's going to be a multi-year effort to fix it. Why does a company want to waste their time and money for Facebook to fix their ads issue that is going to take multiple years? Okay, companies aren't going to wait multiple years. That's the beauty of the system. When a product, a system doesn't work out, they move on to the next that will fit their needs. Right now, that looks to be Google. Amazon may be up next. Okay, I mean, this is really fundamentally bad for Facebook, and I really, really can't stress that enough. I mean, they may not ever get to what they were once more. Okay, and I'm really, really stressing this for all of you. Please do your DD into the companies that you invest in, because I'm really starting to bite the bullet. Okay, PLTR, I'm telling you right now, I'm reading this earnings report very detailed. I'm going to be listening to their call for PLTR. PLTR, from a personal standpoint, is on thin ice with me. I'm down like 40% overall on my overall position. I'm not holding PLTR through penny stock levels when I've got monster companies like QCon reporting earnings and Microsoft and Apple guiding up. I'm not at that point anymore as an investor. And I'm talking from a personal standpoint. Okay. So that was my thought process when reading that. Okay, this is a multi-year effort. Revenue is taking a big hit. Like I ran the numbers, read my notes if you want, because I posted pictures in the long-term investments channel, I believe. Okay, that was my conviction for puts, because this was really bad in Q3. But notice what they said. It's a multi-year effort. Okay, they didn't say it would be a 1 quarter or a half a year effort. This is going to be an issue that lasts for years. That's why I went short. Now, if any of you are thinking to short Facebook puts again the next time, keep in mind, this is twice now that the market has been told this is going to take years and years to fix. The market is pricing that in now, and the market knows that. The market prices everything in right away, and that's why it hates surprises. That's why these earnings, when they come for companies, can be really big or really bad news for the company, because if it's a good surprise, the stock can fucking rip to the high heavens, like a stock split. That's a positive surprise. Look at what Google did. Okay, look what Facebook does with a bad surprise. It gaps down 2 earnings reports back to back. Okay, so this is starting to get priced in. Facebook puts next time, probably just not going to even pay attention to Facebook earnings at all. Okay, now I'm going to talk about Netflix here real quick. The CEO, for the first time in 10 years, said what he never should have said. Competition is now an issue. Really? Netflix CEO says competition is an issue. That's very interesting. And now I saw some bull cases for Netflix on StockTwits, because there's some good people on StockTwits. A lot of them, probably not, but there are some good people on StockTwits. And talking about Netflix, and I threw out there, the CEO says competition is now an issue because there's so many streaming services. Okay, one bull's great idea was Netflix starts leasing its shows and products and movies that it makes itself to other networks and other streaming services. Okay, let me think about this for a second. If Netflix starts leasing its own products that it spends its own money on to other networks, why should I pay for, let's say it gives, I don't know, You, the Netflix show You. Okay, let's say it leases You to HBO Max, and HBO is leasing it from Netflix. Why should I pay for both? If Netflix is going to lease its own products to other streaming services, why should I pay for both? I'll just pay for the one that has both content on it, and I'll just cut Netflix out, because Netflix isn't taking other networks products, right? Netflix isn't taking NBC and CBS shows. If anything, they're going right back to the companies that made them and their own streaming platforms. Okay, this, I really do firmly believe this is a big reset for the market. A lot of these companies that got inflated with COVID, Zoom, Netflix, Roku, Peloton is already there. Peloton will be penny stock before long. Okay, I mean, I really firmly do believe this is a big reset for the market, and it's because smart money is going to come back in and fundamentals start mattering. Okay, now I want to talk about Amazon real quick. I haven't gotten a whole lot of notes, and I'm going to talk about it right now. Personally, I don't think Amazon's worth playing. Okay, I'm reading through Q3 for Amazon. There's a few worrying signs if you're bullish on Amazon, but I don't think it's worth playing. One, because it's hella expensive. Okay, Facebook, those puts 91 cents. Okay, I risked it because I can afford to be down $91, zero or hero. I can afford to take a $91 hit at open, and I'm perfectly fine to keep trading for the rest of the day. Okay, Amazon option premium, probably not going to work that way. Okay, the reason, I'm going to say this right now, the reason I don't think Amazon is worth playing, one, because of how expensive option premium is. Now, if you have a $50,000 account and you want to lotto Amazon puts or calls, have at it. That's not going to really dent your account. But if you've got a $5,000 account, a $10,000 account, I really don't think it's worth playing. Okay, the biggest outlier of all for Amazon, if they announce a stock split, it's going to go to $4,000. I'm saying that right now. The market rips to the high heavens, shorter term, off of sympathy. Amazon will go to $4,000 off of a stock split announcement. I'm just saying that right now. It is not worth it. Facebook, that risk was never there. Okay, that's an added risk for Amazon earnings that Facebook never had. Okay, same thing with Netflix. A lot of people lottoed on Netflix, and some people made it out okay. All right, Netflix was never going to announce a stock split. Amazon, they're the last ones to announce a stock split. Okay, Now, if you decide to do that, they have said for a long time they're not going to do a stock split. Google was never even questioned about it, as far as I know. And then just last or earlier this week, all of a sudden they just come out and say, we're doing a stock split. The board approved it. And that sends the stock apeshit. That was not priced in at all. Nobody in the market was expecting that whatsoever. Okay. Amazon, people have been asking and waiting for it. But either way, it's still going to rip the $4,000. So it won't be that big of a surprise, but it's still going to give the catalyst it needs to rip. Okay. Now, I didn't read this entire report all the way. I'm not going to scroll through it like I did with Facebook's. I'm going to run through some of my notes. The CFO talking, he didn't give some forecasting and didn't give guidance basically on anything. Okay. When you don't do that for the market to price anything in, that means whatever you report, it leaves open the possibility of the market having a very, very big reaction. Okay. If the market can't price anything in, that means it has nothing to anticipate. So if they report really good numbers, say they somehow beat everything and they don't announce a stock split, Amazon can probably rip off of that. But if Amazon misses estimates, whatever it is, all these estimates that the market has priced in, that's going to be a really, really big double whammy for Amazon bulls and shareholders and the company itself. Okay. They did not give any guidance from what I can read and find. The market is really not knowing what to do with Amazon. And here's the uncertainty right here. Amazon is down $200 on the day. Okay. 7% drop on the day. This is what fear has done because Amazon doesn't give guidance. Facebook gave a little bit of guidance, not the best, but they still gave it. And look what happens. Here's Amazon. People are hella scared right now. Okay. Amazon down 7%. Look at Apple. It's barely red on the day, red by 68 cents. Microsoft, okay, it's red on the day a little bit. But look at AMD. AMD's barely red. NVIDIA, it's fairly red. So there's some tech stocks that are holding their own today a little bit. Apple being one of them. Okay. AMD is another. AMD also has the wind in its back because of earnings this week too. Okay. Amazon, though, besides Facebook, Amazon is an outlier. Down 7% on the day. You would think Powell was talking tomorrow and everybody was freaking out over 0.5% rate hikes, judging by this. But it's not. People are fearful. And Amazon didn't give guidance. That's really, really, I mean, it's not really, really bad news, but you're asking for a really ugly reaction. Okay. One thing that stuck out to me real quick about this CFO, he's a funny dude. I liked what he said. In one line, he talks about a new revenue stream that is really picking up pace for Amazon. And I think the total revenue was like 110 some odd $1 million. Okay. $1 million, $110 million. That's a lot of money. The very next line, he says that the company has incurred a lot of COVID related costs. And I'm not directly quoting here when I say this, but those costs that they incorporated because of COVID from testing and PPE and all that good stuff for their employees, it was billions in extra costs. Okay. The line before that, he says something about $110 million profit or revenue off of something else. The very next line, he says billions of dollars in incurred costs because of COVID. Really? Billions of dollars in added expenses far outweigh $110 million in profit. And he said billions. I'm quoting there. He said billions with an S, so it's plural, not 1 billion. I mean, he's a funny guy because it made no sense as to why he said that back to back the way he did. Okay. Let me see. I do want to read one quote because it's interesting. This, obviously, for Q4 for Amazon, everybody's going to be looking at the holiday sales. Okay. Here's a direct quote from the CFO. Inventory placement was frequently redirected to fulfillment centers. This resulted in less optimal placement, which leads to longer and more expensive transportation routes. The reading that I did get done in this transcript, Amazon's problem is the supply chain and lack of labor. Amazon had to constantly redirect their products to fulfillment centers and distribution centers where they had the labor force to deal with them. Okay, it sounds like Amazon is really, really understaffed right now, and they weren't able to provide the best service that they could. So they were constantly redirecting stuff. Well, when you're constantly redirecting stuff, that's more and more money you're paying on transportation and costs. Okay, that's more gas money that you're paying. That's added labor that you're going to pay your drivers and all that good stuff. Okay, these costs started really, really adding up for Amazon because of the lack of labor that the company saw. Okay, if this if that labor hits them so bad in this quarter four and their added expenses and their labor shortage caused a miss, that's going to be a really, really, really double whammy to Amazon. I mean, it's going to be rough. Now, the saving grace that Amazon can pull, because I think Amazon's earnings is going to be bad. I really do. But I still don't think it's worth playing. One, because option premium is so expensive. And two, is because they can always pull out the saving grace with a miss and announce a stock split. If they announce a stock split, Amazon rips to the high heavens. It's going to happen. I'm saying it right now. It happened with Tesla and with every other company that did it. Okay, it doesn't matter about their earnings. If they announce a stock split, it's going to $4,000. The added risk, I don't think, is worth playing Amazon earnings for that reason. All right, that is basically my big spiel for today. I know I covered a lot in this Zoom meeting. I really hope my Facebook analysis made sense because it was all about reading quarter three. Okay, so now as this earnings season comes to a close, I'm going to really do my due diligence into Netflix's earnings because Netflix is my next lotto pick. The CEO should have never said that competition was an issue. That's a fatal flaw. That's a fatal error, in my opinion. And I'm looking to capitalize on it if everything lines up really well with it. Come, let's see, what is it, January? Come April. April will kick off the next earnings. So come April, I've got Netflix in my sights for my next earnings lotto. And the total reasoning so far, I haven't done any reading yet. CEO said what he did. Should have never said it. All right, now for everything that I said, oh, good. We got some questions. I have found spread to be good. Oh, yes, spreads definitely can help mitigate losses and straddling. Okay, I mean, if you went $100 in call premium for Facebook, and then you did $100 in put premium for Facebook. Okay, so long as the implied move is met, one option will take a total loss. The other option will be in green. Okay, $91. Let's say you bought $91 in Facebook premium in calls, $91 in the puts for the lottos. That $91 call premium, it's dead. That is literally $0 right now. But look what that $91 put premium turned into, $2,600. Okay, so now it turns into $2,500. That's a really good way to mitigate your loss. The only issue is it has to beat the implied move. Facebook's implied move was $26. We ended up getting what, like 80? So that was never a worry either. All right, does anybody have any questions for me for anything that I said? And it can still be psychology or risk management related for anything else that I said. Absolutely. Absolutely. Thank you for coming on. Let's go ahead and look at SPYs. Triple Qs. Looks like we're at the new low of day. Oh, yeah. And you know what? Coincidentally, real quick, let me just point this out for everyone. Triple Qs never hit that supply zone yesterday. Look what triple Qs give yesterday. You could have shorted triple Qs yesterday in a sympathy move off of Facebook earnings. Okay. Say I didn't want to risk it with Facebook earnings, but I figured Facebook would shit the bed. Look what triple Qs give yesterday for the daily candle. And I saw this after close yesterday. Didn't even pick up on this. That's a very bearish daily candle. That's a reversal candle with volume at the top of a trend. Shooting star, I believe, is the correct term. Sometimes I get my words mixed up, the candlesticks. A shooting star at the top of a trend with volume. That was a short setup in of itself. Forget Facebook earnings. That's something to really watch. If I'm feeling bearish for Amazon into close, I might swing some triple Q puts. I'm throwing that out there right now for anybody who's still on. I'm debating it. But again, Amazon says that stock split is happening. Everything rips. Everything. Facebook might even go green for a day. So there is some added risk tonight with swinging anything in the tech sector because Amazon is really holding the keys to the kingdom now. All right. But if there is no questions, I'm going to go ahead and stop this meeting here.